Welcome to today's deep dive. So, usually, when you look at a manufacturing company, success is measured by, the speed of the conveyor belt. You build a widget, you try to sell 1 million of them, and you just obsess over mass market dominance.
Right. I mean, the management team wakes up asking, how do we sell more today?
Exactly. But the source we're looking at today, the Ferrari thesis, well, it completely inverts that logic. We're looking at a business model that actively refuses to meet customer demand.
Yeah, it's wild. Their management wakes up asking, how do we make sure not everyone can get our product?
Which means if you evaluate Ferrari the way you look at Ford or even Tesla, your math is going to be wildly off. You really have to evaluate them like Rolex.
You do, because regular car companies ask how to push volume, and Ferrari just, well, they don't do that.
Okay, let's unpack this, though. Because if they aren't actively acquiring new customers, how does the business actually grow? I mean, is Ferrari essentially just an exclusive country club that continuously raises its membership dues?
That country club analogy is actually spot on. And to see how they grow without mass volume, you just have to look at who is buying. It's a staggering number, actually. 81% of Ferraris are sold to people who already own one.
Wait, 81%?
Yeah, 81. So they aren't even trying to win over the broader market.
That is crazy. So I'm guessing they don't have inventory just sitting on dealer lots then.
Not at all. They don't do discounts. Instead, they just have these multi-year waiting lists. They cultivate a closed loop of ultra-wealthy collectors, They dictate the terms to the customer rather than the other way around.
Here's where it gets really interesting for you listening. Because when you hold all that leverage, you get pricing power that traditional automakers, I mean, even great ones like Porsche, simply can't touch.
Right, because Porsche might sit in the, say, 15 to 25% gross margin range, which is great. But Ferrari boasts a gross margin around 50%.
50%.
Yeah. Out of every euro they make, they keep more than 20 cents in pure net profit after manufacturing, R&D, and taxes.
So if unit shipments are relatively stable, where does the margin expansion actually come from?
Well, it's driven by something very specific. Personalization.
Huh?
Yeah, when you buy a Ferrari, you're expected to customize it. Custom paint colors, carbon fiber trim, bespoke stitching.
And that adds up fast, I imagine.
Oh, absolutely. Those options can add $50,000 to $200,000 right onto the sticker price.
And the brilliant part is why those options are so lucrative, right? Because the massive fixed costs like designing the car, crash testing it, building the factory line, all of that is already fully covered by the base price of the vehicle.
Precisely.
So when a buyer pays an extra 50 grand for special yellow paint, there is almost zero additional R&D attached to it. It drops straight to the bottom line. It's like software level profit margins on a physical machine.
You hit the nail on the head. And when you stack those high margin custom orders on top of each other, you generate massive free cash flow. That's pure surplus money they can use to reward investors.
So what does this all mean for the listener? Where does that cash go?
Well, Ferrari uses it to aggressively buy back their own stock.
Right, which is fantastic for investors.
Yeah.
By retiring those shares, they shrink the total number of slices in the pie. So even if the company's overall size stays the same, the share you hold automatically become more valuable.
Exactly. Which is why, if you are tracking this company's health over the next 5 years, you don't just look at how many cars they shipped.
You look at the margins.
Yep, margins, and you watch that 81% repeat customer rate.
To make sure the loop stays closed.
Yes. And you monitor their order book visibility. Like, are people still willing to wait 3 years for delivery? And of course, you watch those outstanding shares shrink.
It almost sounds bulletproof. But, there's always a vulnerability. You might think their biggest threat is Lamborghini or Porsche dropping a faster car.
You'd think so, but no. Based on this thesis, a faster competitor doesn't destroy Ferrari. The real ultimate risk is accessibility.
So management getting greedy.
Exactly. The only thing that kills this investment thesis is if management decides to chase volume to clear out that wait list. Artificial scarcity is the entire foundation of their pricing power.
The moment anyone who wants a Ferrari can just walk in and buy one, the magic is gone.
Completely gone.
They really are one of the strongest luxury brands on earth that just merely happens to sell cars.
Which leaves you with a fascinating puzzle to explore on your own. If Ferrari's superpower relies entirely on artificial scarcity and actively refusing to meet customer demand, well, could a mainstream brand ever successfully reverse engineer this playbook to build a moat? Or is this kind of extreme, gravity-defying pricing power exclusively reserved for century-old legacy luxury?